All right, ladies and gentlemen, this is the long-awaited natural gas market analysis video. Why are we talking about natural gas, Maverick? Who cares about natural gas? I do, and maybe you should too. And the reason is we have a lot of talk right now that perhaps we're seeing the bottom in natural gas. And if that is the case, this could be the trade of the year when we see short covering in natural gas, because that would be a big one. And in this video, we're going to look at the bull versus the bear case for natural gas and come up with a rational conclusion. How about that? But let's set up the stage for you here. Remember when the government scientists issued their winter 23 forecast, and they said that in the West, the weather is going to be drier and warmer. And this is due to some Mexican dude called El Nino and his wife La Nina, whatever, I don't know, something like that. Who cares? But they told us it's going to be drier and warmer. The weather is going to be kinder and gentler. Well, here's kinder and gentler for you. Yep, this is snow in Hollywood. It is snowing in Hollywood, folks. What's going on here? And of course, as a former Angelino myself, I know that every time it rains in LA, people act as if it is Armageddon. All of a sudden, everybody forgot how to drive because of a few drops of water. Meanwhile, I used to live in Oregon where it rained every day and people drove just fine. Until the Californians showed up, of course. Then the streets became chaos. You see, us Californians, we have a love-hate relationship with our state. It's like marriage. When you talk to married people and they talk about their spouse as the most important thing in their lives, but at the same time, the worst thing that ever happened to them, that's exactly how Californians feel about their state. But the weird weather phenomenons that's going on right now, not only impacting California, but we talked about Oregon, where here's what's going on in Portland. The streets are closed, chaos all over the place. And that's beside the Californian drivers. In Vegas, it snowed and the wind gust was over 70 miles per hour. And in my great city of San Diego, we have a blizzard warning. Yep, a blizzard warning in San Diego. And the storm goes all the way to Chicago. You got thousands of homes with no power. Michigan, similar story over there. We have over 720,000 homes and businesses, no power. So the moral of the story here is when the government scientists say that we're going to have a kinder and gentler weather, I say prepare to freeze your nuts. And I told you guys last year, when they say the weather is going to be warmer this winter, it's due to propaganda. They have political agenda, they want to push natural gas prices down, etc., etc. But in reality, when they say that, you gotta prepare to freeze your nuts. And maybe the heat is absent from Southern California, but you know where the heat is? It's in our utility bills. The bills keep going higher and higher and higher. And who told you that, by the way? The guy you're listening to right now. I said, be careful. Gas bills in California will be up over 300% year on year. A lot of you said, hey, Maverick, you're a conspiracy theorist. You don't know what you're talking about. And now you get a bill worth $1,000 a month because you turned the stove a little higher to cook your $8 egg. We're not talking about the dozen. We're talking about per egg. But hey, Chairman Powell says we have a disinflation process in the country. What's going on here? Anyways, why do we see this divergence? Even though when we look at the Henry Hub, which is the gold standard when we look at natural gas prices, the Henry Hub is pretty much down in the toilet. It's a crash. There is no other way to look at it. But at the same time, California gas prices continue to move higher and higher and higher. Why do we see this phenomenon? The answer is, number one, we have our own logistical problems here in California. For example, the lack of proper storage facilities for gas because, oil and gas is evil and we don't need it anymore. But each market has its own set of futures. For example, the Henry Hub comes out of Louisiana, and we use this because most of the natural gas exports, LNG, happen from the Henry Hub. So we look at the Henry Hub futures as the standard and the most influential commodities futures for the natural gas market. But for example, Texas has its own futures. The East Coast, the same thing. In California, we have PG&E, the criminals, of course. And therefore, while you see the Henry Hub down, the PG&E Citygate futures were actually surging higher because we don't have a kinder and gentler winter as we anticipated, and there is more demand on natural gas in California versus the importers across the Atlantic and Asia who import US LNG. Therefore, Henry Hub is down, but California gas futures are moving higher. So I hope that is clear, because when we talk about the Henry Hub, we're talking about the most important natural gas futures. If it moves higher, it doesn't matter what happens in California. California gas futures will also move higher based on the guidance from the Henry Hub. So if you thought that the pain has peaked for the Californian consumer, think again. Because if we do have a bottoming process in the Henry Hub, that means the natural gas futures across the country will also move higher, because the Henry Hub is an indicator that we will see a resumption in U.S. natural gas exports. And that means all futures will move higher again, which means you and me will pay more for gas. And forget about what I think. Bank of America says that we have seen the bottom in natural gas futures. We're talking about the Henry Hub now. Bank of America analysts told clients this week that they believe prices have bottomed and will average $2.45 per million BTUs during the first half of this year, before rising in the second half. One risk to the outlook, they wrote, is producers. Flush from last year might be better able to weather low prices and slow to cut back. Now, I will show you that the data suggests that this is not the case, which means that, according to Bank of America, this is the bottom, and higher we go from here. But before we get ahead of ourselves here, let's look at both the bull versus the bear case and see which one makes sense right now. And we start with the bear case, and this case has 5 points, starting with the warm weather in Europe, and then we have the storage capacity, the demand reduction in the EU, oversupply, and the shutoff of the Freeport LNG facility. Now, the bull case also has 5 points, starting with Freeport LNG reopening. Number 2, the blow-up of Nord Stream, which is the pipeline that connects Russian natural gas to Germany. Number 3, the reduction in drilling here in the United States. Number 4, the revival of Chinese demand for natural gas. Number 5, short covering. Now, let's take them one by one. We begin with the warm weather across the Atlantic. For the most part, certain regions here in the US also experienced warmer weather. When we look at the temperatures in Europe, for example, and so far the trend has been below expectations. So the Europeans were preparing for a certain scenario, and they bought a lot of natural gas preparing for this scenario. All of a sudden, things worked out better than expectations due to the warmer weather, and now they have the case of being oversupplied with natural gas, and that pushes prices down. When we look at monthly European gas imports, for example, they've all went down dramatically. We know the case with Russia. There was a cutoff here. They're not going to be able to import gas from Russia anymore. But even for Norwegian and continental LNG, the demand went down. Imports are going down because Europe has enough in their storage right now. And this also contributes to lower prices. And we can see that European natural gas prices went down to almost the same level as Brent crude oil futures. So there was this premium for natural gas over crude. Now this premium closed, and part of the reason, of course, is ample supplies, at least for now. And all of this has been possible only because of a warmer weather than expectations. But even having slightly warmer weather than expectations here in the US in certain regions, that caused demand to go down, because there has been anticipation of the worst case scenario. The folks have to tap off before the winter season arrives. And therefore comes December 22nd, when we realize that we have warmer weather than expectations, at least for certain parts of the country. You can see right away that the gap between demand and production closed down dramatically. In other words, we used to have an imbalance between production and demand, and therefore natural gas prices were higher. But the moment we see this gap closing down, prices crashed. And of course, the bear thesis for natural gas says we will continue to have warmer weather than expectations, and this will lessen the demand for natural gas, and therefore prices will be under pressure for longer. But bear case number 2 is, what about storage? In anticipation of a harsh winter season, European countries tapped off buying natural gas supplies. A lot of this supply came from Russia, as you can see, a lot of buying of Russian LNG to the European continent. But of course, mixed with that is US natural gas, increasingly US natural gas along with Qatari natural gas, Algerian natural gas. But the cumulative effect of all of that, of hoarding supplies ahead of the winter season, is, when we look at fuel stockpiles in Europe, we can see that the trend right now is at the higher range, the top end of the 10-year range. Yes, it is moving down as we see usage of this stockpile, but again, they have plenty of cushion here. The trend is way above the 10-year average. So even if there is a massive storm coming, there is enough cushion that even after using massive supplies to counter the storm, if it happens to begin with, the trend will still be above the 10-year average. It's going to take a lot to make a dent in this massive stockpile. We'll look at European gas storage. Another way we can look at it is this. Look at the trend in red. This is for 23, above 22, way above 21, way above the 5-year average, almost to the max, which again solidifies that we have massive supplies built up across the Atlantic. And they're not going to get to the trend until all the way till October, November of this year. Until then, the bearish thesis say that natural gas prices will be under pressure. It's going to take a lot of storms, a lot of heat waves to exhaust these stockpiles that the Europeans have been building since the summer of last year. Bear case number 3 is the demand reduction in the EU. We talked about building up all of these stockpiles. We talked about the warmer weather. The combination of both causes demand destruction. And as you can see, demand is down across the board. Whether we're talking about France, whether we're talking about Germany, UK, Italy, the demand is moving down, even though we are in the heat of the winter season right now. This is again the impact of a warmer weather combined with a lot of storage. Bull case number 4 is the oversupply that we have in the pipeline. So even if these stockpiles get exhausted, we have plenty of supply built up, and this will push prices down. We'll look at the inventories, for example. This is according to the Energy Information Administration here in the US. Inventories were below the 5-year rolling average, and this contributed to higher natural gas prices. But now we're being normalized. Now the inventory levels are above the 5-year average. They're moving into positive territory, which means that the heydays of high natural gas prices, that's in the past. That's in the rear view mirror. And right now we're looking at more balanced supply versus demand dynamic. So forget about any impulsive move higher in natural gas. This is at least according to the bears. And listen to this. The market currently is oversupplied by about 5 billion cubic feet a day, and with that producers choking back output, U.S. inventories would swell beyond storage capacity before next winter. And this is according to Ryan Smith, the vice president of consulting at energy data firm East Daily Analytics. He also added that prices might still have a little bit of a downside risk. Analysts and energy executives say that producers must dial back output to buoy prices. They expect drilling activities to decline most sharply in the Haynesville Shale, where break-even production costs are higher than the Appalachians, Marcellus Shale, and in West Texas, where gas is an abundant byproduct of oil drilling. And the last bearish case is the shutoff of Freeport LNG. The most important catalyst for the Henry Hub to move higher is for the demand to move higher. A lot of demand comes as exports, be it by Asian or European demand. The Freeport facility is one of the largest. Once it got blown up, we could not export to Asian and European demand. And therefore, you can see a lot of cancellations that took place from June 22 all the way to this year during the shutdown of Freeport LNG. In turn, Asian and European consumers resorted to buying Russian, Algerian, Qatari natural gas, whatever it comes from, but not from the United States, and therefore the Henry Hub futures went down. No demand for natural gas from the US because we can't export. The facility is down. They cancel orders. They shift these orders to Qatar, for example. Now the Henry Hub goes down. And that leads us to the bull case, which starts with the reopening of Freeport LNG. We know lately that Freeport is back in business, back online, and therefore now if we have demand from European or Asian consumers, we can fulfill this demand using U.S. natural gas. And therefore, the EIA is now forecasting a huge spark in LNG exports from the United States. And that is, of course, thank you to the reopening of the Freeport LNG facility. As you can see from the chart right here, Freeport is really, really important. If it's down, a lot of supplies will not get out. But now that we have Freeport back online, look at this. Forget about the forecast of increasing demand. We are seeing demand right now as we speak, stabilizing and moving higher again to the same levels of last year. And now we're starting to export even more than we did last year. So the recovery is already underway. Freeport's back in business, and therefore Henry Hub should move higher. This is the bullish case in a nutshell. And the EIA now forecasts that natural gas prices at the Henry Hub will average around $3.40 a piece. We're talking about per million British thermal units. And the price will go higher in 24. Not as high as it was in 22, but all the way higher to north of $4 per million BTUs. Bull case number 2 is the blow up of Nord Stream. Now, we know that Nord Stream did not blow itself up. We now know that for sure as a fact. But besides the point, we talked about the massive stockpiles in Europe right now. What happens when, not if, but when those stockpiles are exhausted? At some point, they're going to use all of them, and they need more. If they can't get gas from Russia, if that's a no-go, not because of sanctions or any economic hostilities, but because it is not possible, the pipeline is now gone, then Europeans have only one output to buy gas from, realistically speaking, in a sustainable way, and that is US LNG, which means more demand to come for the Henry Hub. The bear case against natural gas says, oh, we have massive stockpiles in Europe, and it's going to take a long time for that to go down. To counter that, the bulls would say, listen to the EIA chief, who warned that Europe's energy war with Russia is not over, and Europe should not take a lot of comfort from the warm weather this season and start building stockpiles for next winter, right now, this moment, which will increase the demand once again in US LNG. And of course, European countries shelled an insane amount of money buying natural gas and hoarding before the winter season. They paid an arm and a leg. They used to enjoy cheap Russian natural gas, at least in the case of Germany. Well, that's not going to be the case anymore. And that is perhaps the number one goal from this war. Besides, of course, protecting democracy and freedom and all of that. But the United States has been pissed off by the billions of dollars that Germany pays Russia every single year to import cheap Russian natural gas. And when you think about Germany, it's a satellite state for the United States. It's a puppet state. We own Germany. We have over 40,000 American troops in German soil. Germany belongs to the United States. And how dare they pay the Russians for natural gas? We want some of that German cash. And now we're going to get it. It's in the bag. The problem for Germany is this US LNG supply that we're about to give them, it's not going to be as cheap as Russian natural gas. Again, good for the United States, good for the Henry Hub, bad for Germany. So when Chancellor Scholz says that Germany averted a recession, what the hell are you talking about, fool? Think about Germany as a company. The input cost for Germany has increased permanently. They have to import natural gas at higher prices from the United States from this point on. No more cheap Russian gas. No more. To counter that, Germany has to increase its revenue. And if the German state cannot do that, then their margins are going down. In other words, this high standard of living that the German population has been enjoying, that is coming to an end now because they have to pay more for natural gas. But all in all, this is a good outcome for US natural gas. And the revival of German demand once they get with their supplies, the revival of this demand now from US LNG facilities will increase the prices of Henry Hub dramatically. Look at what happened here. European LNG imports by source. The share of US LNG has been increasing dramatically. And once this Russia supply goes to zero, because it will go to zero, to begin with, they're no longer allowed to import Russian natural gas. Number two, even if they want to, it's not possible because Nord Stream is down. So we're going to eat more and more. By we, I mean the USA. We're going to eat more and more share of European LNG imports. That means more demand for the Henry Hub. That means higher prices for the Henry Hub. And U.S. natural gas companies are already preparing for this outcome. They're expanding and building more facilities, more terminals for exports. We know what's coming. And what's coming is a lot of German cash. And in the receiving end, a lot of regasification capacity is being added in China, in Europe, in other Asian countries, in the Americas even. So now we'll have a match. The increase in both export and import capacities, which means more demand, more volume for the Henry Hub. There is this misunderstanding. Sometimes folks say, hey, when Freeport LNG goes out of business, doesn't that mean that lower supply meets higher demand and higher prices should be the outcome? The answer is no, because we have a lot of outputs for natural gas. Demand will be shifted. If demand cannot be met by Freeport LNG, aka the Henry Hub, then demand will move to Qatar. Demand will move to Algeria. Demand will move to Russia. But when we have the exporting capacity to meet this demand, then demand will come back to the Henry Hub. And this is a good outcome, which will push prices higher. Case number 3 for the bulls, the reduction in drilling. And this is what you should be looking at when you talk about the supply versus demand dynamic. Expanding export facilities, that's good for the Henry Hub. Dialing back drilling activities, that's good for the Henry Hub because that means a reduction of supply while demand continues to build up. And now that natural gas prices plunged at the Henry Hub, natural gas companies are responding by dialing back on their drilling activities. And this is done to balance demand versus supply, to push prices higher. And when we look at the rig count, for example, it appears, at least for now, it appears that it has peaked. And now we're seeing the rig count moving down, which means supply will be reduced, demand will build up. And this is because European countries will exhaust their storage. At some point, they have to exhaust them. In the meantime, US producers are responding by reducing supply. So things will get more balanced now. There was imbalance. There was a lot of supply versus less demand because of a warmer weather, because of built up in inventories. But now the picture will get better. And that means higher prices at the Henry Hub. When we look at the trend right now, it is way below the year-over-year trend, way below the 5 years average trend. And the reason is we're not seeing a lot of withdrawals. The annual withdrawals right now at 100. Last year, it was 195. What does that mean? It means there is no need for withdrawing right now. There is no demand for now because of the warm weather, because of the storage capacity, not just in Europe, but here too. It's all filled up for now. No need to withdraw, and therefore no demand for the Henry Hub. The question becomes, what happens after that, once we're past the winter season? And oh, by the way, the suppliers are not drilling more. We have to withdraw more and more and more out of the storage facilities. And this demand meeting a reduction in supply means higher prices. For now, when we look at storage volume, look at this. You see that little light blue column that you see right there at the end? For this month we're in right now, volume is at the higher end of the range, the 5-year range when we talk about storage volume. And this is a main corner of the bear thesis. Look at the storage volume. It is way higher than average. Yet the bulls will counter and say if we have less drilling activities, then we have to exhaust all of this volume out of storage facilities. And it will take a few storms, maybe a warmer summer season, but at some point this will come down to the 5 years average, perhaps all the way down to the minimum of the 5 years average range. And at that point, when we get there, not if, but when we get there, if suppliers are not drilling anymore, then you bet prices at the Henry Hub will move higher in anticipation of that. Not just after it happens, but in anticipation of that happening. And therefore, the question becomes, are we seeing the bottom right now in anticipation of what's about to happen in the summer? Keep that in mind. Bull case number 4 is the revival of the China demand. We talk about China reopening all the time. If China is indeed reopening, then they need more natural gas. And the demand for natural gas will be revived. Now, China has been buying cheap Russian LNG. We know that. They've expanded their export facilities for Russian natural gas. They're building new pipelines between China and Russia. We get all of that. But will it be enough? Will China put all of its eggs in one basket and buy natural gas exclusively from Russia? As we speak right now, despite all of the tensions between the US, Russia, and China, the Chinese are still buying US LNG, believe it or not. And if they are going to reopen, you could say, okay, the Europeans are now not buying Russian LNG. All of a sudden, Russia has spare capacity to supply China's reopening. But China wants to keep some relationship with the United States. It keeps the dependency. Keep your friends close, keep your enemies closer. And we can see already that China LNG imports rising significantly higher. I don't doubt that they will import more Russian LNG, but the proportion of US LNG will move higher. So if China imports 20%, 30% from the US, now that we have a revival in demand by China, the volume of demand will move higher. Not the share, but the volume, and this added demand should push the Henry Hub higher. Last but not least, in the bull case for natural gas, what about short covering? We know a lot of shorts once we found out that this winter season will be warmer, at least across the Atlantic and Europe. A lot of shorts piled in. They managed to crush the Henry Hub. It is one of the most epic crashes we've seen so far. If we have a bottoming process in Henry Hub, and we have a revival of demand coming, and the demand versus supply dynamic will be a lot more favorable for higher prices, wouldn't that panic the shorts, sitting at massive profits? I mean, we've seen what happened in the equities market this year when shorts started to cover. In the very overbeaten names, it turned into a speculative orgy, and now prices are out of whack again. And the same could happen in natural gas. If we do have the initial stage of short covering and then it gets out of hand, we could see the Henry Hub exploding higher, just due to the amplifier that we call short covering. And that concludes the bull case. So now that we talked about the bear versus the bull case, you tell me. I don't want to influence your decision at all. You know where I stand if you've been watching my channel for a little while. But I want to hear from you. You tell me in the comments which case made the most sense for you. Let us know. But before we wrap it up, folks, we have to look at some charts here for natural gas, and we start with the Henry Hub. This is a weekly chart for the futures. What do we see here? Right away, we see a gap that goes all the way back to 2020, and this gap stands at around 2.14. We got there, we filled the gap, and then the Henry Hub closed at the highs of the week. Now combine this with the momentum indicators, the RSI, the MACD, all way oversold, indicating a rebound coming. And if this massive rebound happens, we're going to have resistance at around 3.53, which would be a gain from this point on worth about 36%. Now, if that is the case, how do we play it besides buying futures? How about we buy some stocks, natural gas stocks? We start with a strong / the overvalued, then move down to the undervalued. When we talk about overvalued / strong, it is for reasons, because these names have the momentum, these names have the growth to back it up. And of course, we're talking about Cheniere, the ticker LNG. This is a weekly chart. I hoped that after earnings, the chart would go down to 120. I think I made a mistake in the video by saying 130, but it is 120. That didn't happen. Cheniere's numbers were way better than expectations, and therefore, the chart did pop significantly higher, back to trend again after violating the trend for a little while. And we see this buying coming with huge volume. Not only that, it is combined with a firming up in the RSI and the MACD indicators, indicating bullish momentum coming. The problem with this chart is we have a series of higher highs for now. If the chart stalls at this point, it will form a lower high. And if we see a lower high, then the top is in and LNG will go down. It will break the trend once and for all. And therefore, perhaps we want to look at charts that are not doing so good. Maybe the opportunity in buying those who've been beat up. Take, for example, the ticker CHK for Chesapeake Energy. This is a weekly chart. It did violate the trend line once and for all, but it is making a comeback. It is firming up. We do have resistance at around 93. Now, the name is severely shorted, and the reason is it has bad fundamentals. It's not as good as Cheniere. So again, if you're going to buy CHK, you want to trade the name, but I would not go as far as own the name. I think as investors, we have better choices and better companies. And I'm going to show you some of them right now. But before we do that, if CHK pops higher, and it goes all the way to 93, which is the resistance that we have right now, besides the trend line, of course, that could be a gain worth about 9% from this point on. But perhaps instead of chasing Cheniere and Chesapeake, maybe you want to chase Coterra instead, a name with solid fundamentals. We'll look at the weekly chart. Look at this. Both the RSI and the MACD indicators are firming up. Last week, we saw a big reversal candle to the upside, coming with a lot of volume, indicating that perhaps you want to be in this chart. If you happen to be bullish natural gas, if you happen to choose the bulls camp after the discussion that we just had, then Coterra CTRA should be at the top of your list. And the target here becomes resistance number 1, at least, the top of a breakdown candle at 27.51. Now, if Coterra passes that test, we could see an explosion. In the case of short covering, for example, that could take the chart all the way back to the highs. And here's another chart, another company with better fundamentals than, let's say, Chesapeake, for example. I happen to own the name. It is EQT. This is a weekly chart. And as you can see, we have a rolling top pattern, a saucer topping formation, but the chart did break above this curve pattern. We see the RSI reversing negative divergence, and the MACD is about to do the same. We see a massive pop candle out of the saucer topping formation with higher volume, all indicating if this momentum continues, then in no time EQT will be above 35. That is support / resistance number 1. And then we have 39, and if EQT managed to beat both, then it will go back to the highs. Now, EQT happens to be a little bit of a high beta versus Coterra. High beta means it moves up and down more impulsively than a low beta stock such as Coterra, which means the gains are amplified in EQT, but so are the losses. So now you have a variety of choices. You can pick the safest one, Coterra, for example. You can pick a little bit of high beta in EQT or CHK, Chesapeake. You can follow the momentum in LNG, Cheniere, or you can also follow natural gas prices higher by buying fertilizer stocks. We know that natural gas is an input cost for fertilizers, but it also means that they can charge more for their products. And the beauty becomes, what if these fertilizer companies, be it Mosaic, be it Nutrien, or whatever company you want to follow, what if they've been hoarding natural gas, which is the input cost for their products, at a cheaper price, but then they sell it to the market at the higher price when the Henry Hub recovers? If that is the case, if we find out that Mosaic, for example, has been hoarding natural gas at a cheaper price, and they're going to sell it at a higher price when the Henry Hub recovers, then their margins will explode higher, and you will see fertilizer stocks outperforming natural gas stocks. So keep that in mind. For now, Mosaic is facing the trend line. If it makes it above the trend line, we have some indicators suggesting that that will be the case. We'll look at momentum indicators, the RSI, the MACD, all firming up. The buying last week happened under higher volume than average. If that is the case, we have the resistance at the trend line at around 53. If you want to be on the safe side, wait for a weekly closing above 53. Because if that happens, then comes the demand, then comes the short covering. We could see Mosaic exploding higher. We'll talk about targets when that happens. But the most immediate one we're looking at is 53. Now we have to talk about Boyle, because a lot of you love this name. A lot of you are betting that natural gas is going to explode higher. And to maximize your profits from this explosion, you got to go all in Boyle. Look, I'm going to say it once. I've been saying it over and over and over and over again. This is a high levered index. You don't own these kind of indices. You rent them. You buy them for a little while to chase momentum up or down, and then you dump them. This is not meant to be an addition to your portfolio. Otherwise, you're going to wreck it. Is there a case for an upcoming explosion in BOIL? Yes, there is. If this is indeed the bottom for the Henry Hub, we will see massive short covering to come in one shot, most importantly, not over time. If it happens right away and we see the Henry Hub up 50% in a month or so, then you bet the BOIL will explode like you've never seen before. And it could be the trade of the year. But what if the recovery of the Henry Hub is gradual? If that is the case, then holding BOIL in your portfolio will guarantee that you're gonna lose money. Why? Because the recovery will be gradual. We will see days when the Henry Hub is up. We will see days when the Henry Hub is down. And BOIL will react accordingly. And it resets every single day. It doesn't track the Henry Hub over time. It doesn't track UNG over time. The way I use it is, when I see these impulsive pops in natural gas, I buy BOIL, be it shares or options. Then I take my profits and I rotate those profits to something more sustainable, such as Coterra, such as EQT, such as LNG, Cheniere. It doesn't matter what name it is, but natural gas companies will hold value versus an index that for the most part tracks volatility. It doesn't hold any value. On the other hand, I'm just presenting the case here, both ways. What if you do my strategy, you book your profits and you move to EQT or LNG or whatever, yet we see this massive explosion of short covering at the Henry Hub, and Boyle becomes the place to be. If that is the case, we could see a rally in BOIL to close the gap, the weekly gap at 17.78, and that would be a gain of almost 200%. In options lingo, that would be in about 5,000+%, but that is conditional on the short squeeze to happen at one shot right away, not in a gradual fashion. We cannot guarantee that, and therefore I say the safest strategy, the mature strategy, go ahead and buy Boyle if you want to, but make sure that you rotate some profits to something more sustainable over time, be it a more stable index such as the UNG for example, or better yet the futures, or even better, picking high quality natural gas stocks. And with that, folks, this is the presentation that I got for you for natural gas. I did present the bull case versus the bear case. We looked at charts. We looked at certain news. Now it's up to you to tell me in the comments what you believe. Are you on the bullish side? Are you on the bearish side? And why? Let us know in the comments. But for now, this is all I got for you. If you happen to be a member in this channel, you're going to see the market recap coming this evening. But that aside, this is all I got for you for now. Thank you for listening. Thank you for watching. And I will talk to you again tomorrow. Take care.
That was fantastic.